now have Mr. Devang Mehta, Deputy Managing Director and CIO Equity NDPMS at Spark Capital, now joining us. Mr. Mehta, afternoon, and thank you so much for joining us this afternoon on ET Now. First up, what do you make of the market at this point in time? The big triggers, perhaps tariff uncertainty is expected to wane going forward. Earnings are now behind us. What do you think will be the next big trigger for the market going forward, because of which we could see one leg up ahead going forward?
Hi, good afternoon. Thanks for having me on the show. Always a pleasure to be on ET Now. Yeah, I think very clearly what we are observing right now is that a lot of macro fundamentals in India are coming back to the fore. And this we have been saying last 3-4 months, while the market faced a lot of volatility over the last entire 1 year, and we saw a lot of reasons for sort of market not going up. One, the last 1 year of time correction, which was quite in a way shocking. While all the global markets rallied, India underperformed. If you look at MSCI India, how much it underperformed, I think to the tune of around 23-24% to the other markets, which is something very stark. Secondly, most importantly, what we are seeing is monetary policy support. We are seeing fiscal support. We have seen inflation probably at a multi-year low, 100-month low, if I'm right. I think RBI has been generally been supportive. Government did its capex in the last 3-4 years, but last 1 year, if you look at what it has done in the budget, it left some money in the hands of the consumer. And now with GST rationalization also coming back to the fore, festive demand again sort of coming back, and most important, where market is a slave of earnings, right? So I think earnings in this quarter, if you look at a lot of sectors, there have been at least not a marked improvement, but what we also started to see is management commentary is getting interesting, and in fact, a little bit of more confident body language that we have been seeing. So I think if earnings come back, see, macros have been good, sentiment towards equity is good, global markets right now are supportive, liquidity is not bad. My sense that if start coming in the next quarter or so, there would be positive upside to earnings, and probably, as I always say, we are somewhere near the beginning of the end of downgrades, and maybe the upgrades could start in the next couple of quarters.
Right, Mr. Mehta, also, talk to us about the consistent FII selling, because that has also been one of the reasons why, been a negative for the market. Anytime soon that we could see a reversal in the FII selling, because FIIs are considerably underweight on Indian markets as of now. I know that earnings have also not been, looking very rosy for the FIIs to make a comeback, but, we are expecting the second half to be better. Could there be a reversal in the FII selling then?
Typically, I think that is the hope that the market participants are carrying right now, and why. As I mentioned, some of the reasons that Indian markets had grossly underperformed over the last 1.5 year. Yes, clearly, FIIs, if you look at the construct of the Indian market over the last 4-5 years, and particularly post-COVID, I think it's more of domestic investments that have sort of driven the market. From here on, do we need more FPI support? Yes, we may. Probably for the market to rally and see a typical bull market, we would need a bit of FPI support. Now, if you look at the scheme of last couple of years, while India seemed to be expensive, and there were reasons why India was expensive, there has been a bit of correction, time correction, and a bit of PE correction as well. Now with earnings coming back, I'm not talking about PE re-rating as such. The PE got de-rated earlier. But now with earnings coming back, I think there is a good case that FPIs on the basis of demographics, on the basis of political stability, on the basis of earnings coming back, and maybe India looking a bit more attractive than it was, capex, credit growth, consumption, all these factors coming back. I think there is a good case that sooner than later. It's very difficult to say when would they come back with the full throttle, but I think there's a good case that they might come sooner than later.
So FIIs might come back sooner rather than later, but any sectoral preferences and any sector that you are recommending entering into at this point in time?
2-3 sectors which we have generally been positive. So we for the past 3-4 years we've generally been positive on a lot of engineering, capital goods, power automation related plays, which is supposedly a part of government capital expenditure. But now, even I think after seeing good numbers and good body language commentary from a lot of managements, I think a lot of companies are at full capacity utilizations. So my sense that there will still be a little bit of private capex which will come back. One is that. The second theme, which is very important for India, is the drive towards very strong from savings to investment, which people call financialization. I think there are a lot of proxy plays over there, a lot of depositories, exchanges, wealth management companies, AMCs, broking type of companies. I think most of these companies went through a bit of correction, and now again they are on an up curve. But if you honestly take the next 3 to 4 year view, where a lot of demat accounts would be opened, there is a millionaire that is getting built in India every hour. And the numbers are stacking, that the number of probably the guys, the wealthy guys, are increasing by the day. So this is one theme which would keep on playing well. And the third theme, where there was a little bit of government support required and that has come back, is consumption, and that too typical discretionary consumption. And we are seeing how some of these companies have come up with good set of numbers, not recommending, but certain companies like Titan, some companies in the hotel industry, all these companies, typical the auto pack, which are now sort of benefiting from not only the GST but also the pent up demand which was sort of created over the last 1.5 year. So I think the combination of these three seem interesting at this point.
Right, Mr. Mehta, you mentioned a couple of themes there, especially the discretionary end of consumption, the auto pack, the biggest beneficiary of the GST rate rationalization. But talk to us about the IT pack also, because though IT has seen considerable correction, so in that sense, the valuations seem to be in a good spot as far as valuations are concerned. But there are still global headwinds as far as the global headwinds are concerned, or for that matter, even margin pressure that still persists on the IT sector. So what would be your view on IT?
I think India is typically a growth market, right? So people would want to hunt for growth, and I'm not even saying that buy at any prices, but growth at a reasonable price is where I think a lot of people would be focused. While IT companies may present you with good valuation opportunities, a lot of these companies just a month back were at 52-week lows, and from there we have seen a bit of smart bounce back, and that is where I think some bit of value lie over there. But to me, honestly, if today I want to construct a portfolio, I would be more domestic centric in my approach. And why? Because we know that still the global dependence that IT companies have, or for that matter, even export companies would have, is going to sort of hamper, as there are global narratives which change every single day. One is that. Second, on lower growth, on single digit growth of say 2, 3, 4%. Should these companies probably command the P that they're commanding at this point? Maybe somebody who is a little conservative, there will be lower drawdowns in IT for sure than other sectors, but there is a good chance that he might probably make FD plus type of return, maybe 10% type of return, 12%, 8, 10, 12% is the band for the next 3, 5 years. So if that is the return objective, I think then it's a good sector. But as I said, if somebody probably is in the 15, 18% type of return objective, the sectors that I talked about would make more sense.
So several sectors that you're bullish on, and that's the view when it comes to IT. Mr. Mehta, thank you so much for taking your time out and joining us here on ET Now.